Good evening, friends. Welcome to the HDFC Securities post-budget webinar. I have with me Mr. Deepak Jasani, Head of Retail Research at HDFC Securities. He'll take you through the key points of the budget and give his impressions on what the budget is and how to act forward. I'll add my bit in terms of capital market strategy in the later part of the show. Thank you. Over to you, Deepak.
Thank you, Sharma ji. Uh, yeah. So, good evening, friends. Budget 2018 has focused, as you may be aware, on agriculture, rural economy, health, social sector, senior citizens, and is aiming at working towards easing living in India uh, versus doing business in India, which was the motto so far. Now we are shifting or maybe focusing on this part, ease of living in India. This is normal to expect ahead of the election, so partly it is election driven. The government aims at providing maximum livelihood opportunities in the rural areas by spending more on livelihood, agriculture and allied activities and construction of rural infrastructure. It will ensure full payment of MSP even if the farmers sell below MSP. Emphasis is on generating farm and non-farm employment for farmers. Now, by doing this, they are trying to tackle one area of rural distress, which had hurt the ruling party in the latest elections a couple of months back. So, by doing this, they are trying to tackle this issue of rural issues or distress. FM Jaitley has deftly balanced economics and politics in this budget. Rural focus, as we discussed earlier, will lead to alleviation of the distress or issues in the rural areas. However, the urban population may be a little disappointed at the overall outcome from the budget. The reaction of the foreign portfolio investors to the 3.3% fiscal deficit, which has been estimated for FY19, will be keenly watched, as will be the reaction of the local bond markets in the background of the rising rates abroad. Now, as far as the equity markets are concerned, there are some positives. Now, this include the thrust on rural and agri, which will bring consumption spending trickle down into the entire economy. Cut in corporate tax rate by 5% to companies having sales up to rupees 250 crores versus 50 crores hitherto will benefit a lot of small-sized companies, which will enable them to grow faster. The high spend on affordable housing could keep demand for basic materials like steel and cement buoyant. The tax relief or clarifications for the IBC companies could speed up the resolution of bankruptcy and insolvency, unlocking a lot of funds which are locked up currently in those companies. Over the medium term, we could have a better, fresh supply and more supply of better quality employees and workers due to the higher spend which is forecast on higher education. NFOs like Bharat 22, including debt ETF, which has been proposed, listing of more PSUs, including the merged insurance companies, and strategic divestment proposal of 24 CPSE, Central Public Sector Enterprises, will give more and more opportunities to investors to invest in the equity markets. Now let us come to what are the negatives out of the budget for the equity markets. One could be the impact on inflation due to import duties being raised on a number of daily use items, including edible oil, and increase in the cess from 3% to 10%. Unless the supply side gears up and shapes up in time, and we have a good monsoon, we could see inflation cropping up in the second quarter of the coming fiscal. Interest rates could remain high given the 3.3% fiscal deficit, reducing the attraction for equities and impacting corporate profitability to some extent. Long-term capital gains of 10% could keep away fresh investors and new funds that were being diverted from other low-paying avenues. Long-term capital gains tax exemption was an attraction for especially for new investors post the demonetization, and also diverted a lot of funds from other fixed income space where the interest rates were very low. However, now interest rates are on the rise, so keeping these two things in background, there could be some reversal of that trend, minor reversal of that trend going forward. Now, the union budget is not overly populist, but has something for everybody, except not so much for the urban population. The FM has attached three annexures to the speech, listing out the monies proposed for agri, education, health, social services, and infra sectors. This is the first time that he has done that. FM's proposal to accept key recommendation of the Fiscal Reform and Budget Management Committee relating to adoption of debt rule and to bring down the central government's debt to GDP ratio to 40% is creditable. Inflation and growth remain the two macro variables going forward. If we have inflation under control and growth resurrecting, then we could have another good year in 2018, although a repeat of 2017 is difficult. The union budget could be less relevant a couple of weeks from now, as the focus will shift again to the global events, the macroeconomics and earnings, which is the missing piece so far in the whole valuation game. The current valuation are demanding, and a lot depends on whether corporate earnings will revive enough to justify these valuations or to expand them. So this is what we will be watching out for, and I think broadly the year 2018 could be a stock specific or a sector specific year. What do you think, Sharma ji?
Thank you, Deepak. I think one thing that is clearly we are feeling much more, let's say, light now, because the weight burden of the capital gains tax is not going to fall on our existing holdings as investors. So that's a good thing. But more important thing, as Deepak rightly said, it is not going to be so much attractive for the newcomers to come in equity, because the tax-free nature of the earnings is now no more there. However, what it will do is, I think people will be more willing to switch their portfolios, because the difference between a short-term capital gain of 10%, 15% and a long-term capital gains of 10% is just 5%. So that kind of a valuation. So if you get the price right, I don't think you have to wait for that. So I think it will result into a lot of reshuffling of the portfolios, which is okay. I think the capital markets point of view, this is a good source for the government, that the gains that we booked will be huge, and if the market does well, the taxes, the tax collections of the government will also be buoyant on profit booking. So this is a new source that government has opened, but I think they shouldn't have allowed STT to continue, because now we have two things. Because the reason of STT being levied was that the capital gains tax was being removed. Now we have both. But I think there are uncertainties regarding the GST collections and how much of the collection would come. So they have kept both. But I'm sure, Deepak, this will be revised in the next year's budget, when the government is so much sure that the capital gains tax is coming in very healthy and the earnings also are doing well. So going forward, my sense is that because of the fact, overly, if you look at purely on the headlines, it will appear that it is a populist budget and there's nothing for the stock markets. But I think the fact that the consumers, that the farmers there out there will be getting slightly better price, then he will spend more. Another important point is that this 5 lakh rupees of insurance that is coming in for every family member is great, because you don't have to then save for a rainy day, and the farmer will then start to spend more. So we could see higher consumption and less of savings from the farmer side, which will result into wherever the consumption is going into, those sectors will do well, whether it is autos or whether it is tractors, or for that matter the FMCG. So this overall, I think, is going to help the markets. And the fact that now it is very clear, because we were always, every year, past 3 years, the issue has been hitting us regarding capital gains tax. Now it has come, it can only become better and not more. So I think that is very clear.
So uncertainties out of the way.
Yeah, and we'll go back to
People will learn to live with it.
Yeah, and 3.3% is doable. I think it is doable because the crude that has taken is $72 a barrel, which is, I don't think it will go beyond that. And whatever any fall in crude will definitely add to the coffers of the government.
Right.
So, any takeaway on individual stocks or levels?
Broadly, we may be, for near term, maybe we may be close to a top in terms of indices. These mid and small caps have anyway started to correct and have corrected quite a bit. They may correct a little more from here. Then the turn may be of the large caps to fall. Then at that time, probably mid and small caps may not fall so much because they have already fallen. So at that time, probably the reshuffling between the two caps will continue happening.
I think investors with what you need to do is you should revisit your portfolio, and this is an opportunity to convert some of them, switch to better yielding stocks, whether in terms of growth or dividend. I think you should send those portfolios for analysis by Deepak and the team. So, any other?
And one more thing which is which you mentioned is that the difference between 10% and 15% is very small. So there was some sort of a hesitation on the part of the investors not to sell till 1 year is over. Now that they should come out of that hesitation and keep taking profits
as and when they
come and as and when they look sufficient enough.
Yeah.
And keep rotating so that probably it will require some sort of a change in the attitude of the investors. So you have to be a little more. You will have to churn your portfolio a little more rather than you may have some core portfolio where you think a compounding of 20-25% is possible, but the other part of the portfolio I think you can keep churning and probably the net return would be much higher than what you have been earning so far.
I agree with you, and I don't want the tax considerations to be a deciding factor whether to buy or sell a stock. So if you feel like it's right time to sell, you just sell. And if you want to hold on, even though there are good profits, you can continue to hold on and take Deepak's and our team's advice for that.
Yeah. So now, if you have some individual sector or stock related queries, then you can join the chat with our expert Devarsh Vakil, which will start soon after this webinar is over. I think that should be all. Thanks a lot for being with us and wish you a very happy and prosperous 2018 going forward.
All the best to you. Thank you.